Well, good afternoon, everybody, and welcome to the November 30th edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I had as good a Thanksgiving as I could expect to have under the conditions. I've never done one before in a hazmat suit, but it was still a good one. I'm joined here by Ken Kavula and Kim Butcher. Say hello, guys.
Hello, everybody. Glad to be with you.
Hi, everyone. Hope you're having a great day.
And we will get to Kim. One of Kim's favorite sites is Dataroma, and we won't go too deep into it other than to tell you it's out there and give you a quick look at it. We'll talk a little bit about Omicron, I guess. Certainly the virus is having a certain amount of impact. Certainly inflation continues to have a certain amount of impact, but I got a little bit detoured by the apples and by the bull with the
face mask,
protective gear on there. Somebody sent me a note saying that he's not strapped in completely. I said, yeah, but it doesn't go over his horns. So that's part of it. And then I tried, and here again, true confession, second in a row, I tried to do the inflation reading again, and I got deflected to Greenblatt's series of books that basically revolve around a concept very closely related to the projected return on value that we do. So I want to spend some time talking about that. Ken and I had a little bit of a debate over the Thanksgiving holiday, and I'll let him pick on me when the time comes here. Any other thoughts, Ken or Kim?
Mark, I don't know if you can access Bloomberg Business Week through your library, but they have the most recent one is an entire issue on inflation. And some of the articles are really quite readable with some pretty good concepts in them. So I would suggest to anybody that's really interested in that topic to get a hold of, well, I think it's the latest one. It might be 1 week old now, but it's Bloomberg Business Week, and the cover is kind of a black gray color, and it says inflation right in the middle of it. That's about it on the cover.
Yeah, I can get at that. I will do my best to I don't want my inflation stack to get too much taller without getting more informative. So hopefully we'll actually nail down the stuff. Some of the stuff that we talk about today, Ken, will actually revolve around how we look at companies. You know, even that graph on the right, what does inflation do to that? And that's kind of the way I think about the whole topic. And maybe I'm just weird, but we can talk about that here in a few minutes. All right, go ahead.
No, that's fine. I said, okay, let's get going.
All right. Disclaimer. I see a lot of familiar names. Happy Thanksgiving in your rearview mirror to you. Hugs all around. You guys know the drill. This is an educational demonstration. We will talk about real companies in real time. Everything that we do here is for education, demonstration, illustration, and just simply walking the talk, walking the walk of the modern investment club movement. We have a lot of opinions that we will share. Really, everything is intended to be how to take the analysis and methodologies on discovering excellent companies at good prices and building, taking those actionable items and building and maintaining effective, successful portfolios. That's what this is all about. If we happen to own anything that we're talking about, we do try to remember to disclose that as we go. Tonight, we do have our November roundtable. We have at least 4 stocks on the table at this point. We might get a 5th, but that particular roundtable is now going on. It's been going since July 2010. The annualized rate of return on the features that we have done is 18.5%. So we've actually had a pretty good run, and we hope to see that continue. We've had a little bit of a slump here in recent months, but we're not alone in that regard. So we invite you to join us. If you'd like to be reminded, that is a monthly webcast, last Tuesday of every month, generally, at 8:30 Eastern Time. And if you'd like to be added to a reminder list on that, please send an email to nkavula1@comcast.net. If you have questions, comments, want copies of the slides, or suggestions for future topics here, we do this every Tuesday at 2. Our 2 email addresses are there, markr@manifestinvesting.com and kkavula1@comcast.net. we welcome suggestions and positive comments. We even welcome a few negative ones from time to time, as long as they're not about me.
Or me.
Or Kim. All right. Here is kind of our standing bullpen, the stuff that we are considering talking about from top to bottom. And we will touch on these topics either today or in future sessions. And the bull is fully adorned in his protective gear, so we're safe, theoretically. We'll cover Dataroma today. We're going to take another time out. We'll talk a little bit about inflation, but do want to give it the appropriate coverage, and I just can't muster the energy to do it right now. Give you a quick update on best small companies, talk a little bit more about these long-term S-curves. I think that'll be a part of our agenda for a few months to come as we explore some of those companies that are listed there in that, and some of those other topics are going to creep up too. I put the snippet at the bottom down there just to reinforce this notion of leaps. Leaps are long-term equity appreciation options, and they can go out 2 or 3 years. They're not like those weekly options that you hear so much about. They actually go out a few years. Some of the people that are listening have done them. Some of you have done them quite successfully. Not many of us have really embraced them fully, but Joel Greenblatt basically says that people who are as disciplined and dedicated and as attentive as we are can really do quite well in that realm. So we probably want to understand it whether we choose to do it or not. Ken, what are your thoughts on leaps, long-term options?
Well, I'm guilty. I'm one of those ones who've done them. I do it on those stocks that I've followed for a long time. And when I recognize that essentially volatility is my friend and the market is giving me a gift, I have no qualms about buying a long leap for a year, 18 months, and instead of having a, let's say, 30% return in that time, I might have a 25% return. It's just, I mean, actually, you know, you have a better return with a leap than you do with just buying the stock and owning it, even if you're getting dividends.
Yeah,
I got those percentages wrong, so it's just.
It's definitely a leverage situation.
And it's definitely a thing that you do. I persistently, when I do it, I make sure I know my stock inside and out, and I recognize that the market is giving me a gift.
Well, we'll cover it in some greater detail. I know that Hugh McManus has very successfully used them in the past. I'm also aware of an investment club out in Seattle which does them pretty much exclusively, with a very strong track record. So it's a subject that probably, well, it does have some merit to at least understand and make some decisions. Any other thoughts, Ken?
Nope, I'm ready to keep plugging away here.
All right, here's a quick update on our best small companies. Ken said that I'm going to panic you with the graphic on the upper right. I hope not. Note the scale is pretty tight. That's basically the value of $2,000 in the traditional, which is the buy and hold version of the situation. Active is the one where we have made one sell. We sold eHealth and replaced it with Pachira Biosciences, and that the position in Pachira, even though it's gone down, has gone down less than eHealth has continued to go down. Hence the blue, which is the actively managed version of this, of the best small company list for this year. And again, it's just kind of a test or a demonstration of actually applying some of the selling criteria, the selling discipline to the portfolio. It's a portfolio management demonstration. In this case, eHealth dropped rather dramatically, basically outstripping or underperforming the market by 32% within a week of, or 10 days of Halloween. So we exited that position and replaced it with Pachira. So that we are watching for any relative return to sink more than minus 20. And we'll include this as part of our updates. We won't spend a lot of time talking about them unless we have a specific item on one of the companies or perhaps some type of a fundamental update to share along the way. And of course, the market is still hovering basically flat at right around $2,000. So that could,
I will say, Mark, it's rare after 1 month of the contest to go by to have our benchmark return at zero.
yes.
It's just we haven't experienced those kind of markets. We've either experienced really positive markets or occasionally really negative markets, but this kind of whiny market is very difficult to walk across or to deal with.
Ken, in that case, my question is, how negative do we have to go today to qualify for the Sam Stovall bonus?
Yeah, Stovall was on one of the programs yesterday, and he was just putting facts about December. They asked him about the Christmas bonus that comes in the market, and he said, well, that happens about 70% of the time in a normal market situation, and December is usually the second best month of the year after April, and the stocks tend to go up during December 3 or 4%. He did have another fact, however, that was really interesting, and he said if November is down, then that 70% of the time that December outperforms moves to over 80%, almost 84%, and the return moves from about 3 or 4% to about 7 or 8%. So maybe I'm kind of hoping for a down November. This day today is probably going to take us in a downward November for a lot of the indexes, and then I'll be sitting right with Sam with a 83, 84% chance of December bringing me really good returns.
Well, if that's the case, I mean, Jerome Powell is out there today opening his mouth routinely, and it seems like every time he answers a question, the stock market loses 500 points, Dow points. So, I mean, maybe we're set up for it. Wild stuff.
Right. I think we also need to remember that how much has this market gone up this year, and can we expect those same statistics to hold through when you've had a market as positive as this one's been this year?
I had another statistic, Kim, that'll answer your question. The intuition says that after you have a really good year, you're going to have a really bad year to follow it to kind of balance things out.
Oh, pick me. I know where this is going.
Mark. Go on, finish it, Mark. Go on.
Go ahead. I don't want to rain on your parade.
Well, in fact, if you go back and examine really bad years and then look at the year after, you find out that the market actually does not a whole lot better than average, but a little tiny bit better than average in the next year.
Yep.
Is that where we're coming from, Mark?
Absolutely.
Okay.
It all comes down to sample size, guys. I bet you I use that phrase at least 10 times a week when I'm reading financial, and I'm doing air quotes right now, journalism. There just is not that much out there to draw these patterns that everybody thinks they see most of the time. Oh well. All right. Let's talk a little bit about Dataroma. Kim, this is one of your favorite sources. Want to go ahead and give us a little bit of a rundown on it?
Sure. I do a lot of reading on the internet. That's how I try to keep learning and growing as an investor. I kept seeing references to Dataroma, and so then I went out there and I went to the website, and I was like, this is interesting because red flag or star, this is a free site as of this moment of time. We all like to see what is Buffett buying, and well, they get the quarterly reports. They have, I think, 30 different people that they follow. Very simply, Mark, if you can go to Lilu from Himalaya Capital.
Okay, right here.
Yeah, that was updated as of November 15th, guys. Okay, the reason why I like this name, and this is a stock or a manager I will follow, because everybody knows Munger, the partner with Buffett. And the bottom line is Munger only given his money to this man, Lilu from Himalaya Capital, to manage his money. That's the only person he's ever shared his money with to manage it. And so I like getting ideas here. And it looks like you can see by the buys of what he bought, like he bought some Berkshire Hathaway in the third quarter. It'll go there and back. I mean, so it looks like for the last quarter 1 and 2, he never bought anything, but in the fourth quarter of 2020, he bought some Apple. And then there you have PDD. I guess I don't even know what that is. So that would be an idea of a stock of what to get.
Yeah, internet content company out of, I believe, China. Is that correct?
Pinduoduo, isn't it?
Yes.
Yep.
So he bought some Facebook the third quarter of 2020. So and he added 118%. I do get kind of greedy in seeing how much did he add, how much did he buy. So it gets me an idea of what maybe I should look at. So like it looks like in the second quarter of 2020, he bought the Facebook and then he bought more. So I like looking to see what other rhinos are buying and see if I can understand why. Like Bill and Melinda Gates Foundation, he's got that one on there. And I did not understand why they waste management. But when you think about it, we are going to have trash forever. The trash man is going to come and hopefully take our trash and get rid of it. And they have a decent dividend. And as a result, right now, it is 12% of his portfolio. So it's a great way to go get ideas, great way to see what they're thinking. And maybe if you could figure out why they're thinking that way, it would be an idea of where to find stock. So yeah, that's why I like this website.
Isn't it interesting, Kim, that the Microsoft guy in the top 10 holdings there doesn't have a single tech stock?
Yeah, doing a lot with real estate too these days.
Yep.
Yeah, so you can look at it in real time. I mean, I find this kind of fascinating. Whatever Upstart is being sold by Loeb. I mean, there's some interesting stuff. So this is no different than what we do with the small companies. You find people who know what they're doing. This is going to have a large company bias, obviously. I didn't know that they rotated the quotes. That's a different quote. But you can actually zone in on some of the best, and every once in a while there'll be a new idea. The one thing I noticed, Kim, was you scroll down this homepage a little bit. I'm kind of interested in this box right here that has most recent top 10 buys within the last quarter. And I'm thinking I'll run an analysis on Hillman Solutions because I've not heard of that one. But again, keep in mind that this is going to be large cap biased for the most part.
Well, and then there's Lockheed Martin, and I kind of talked about that, or you presented it for me because time got away from me and I couldn't be at a round table. And there it is, number 2, Lockheed Martin.
Yeah. So I think this can be a source of the first thing I did was go down the list and see, well, which ones haven't I heard of? And this Hillman jumped right out at me. So
I've just jotted down that one, Mark, but I've also jotted down Ginkgo Bioscience Holdings. DNA is the ticker. That certainly is something I've never talked about or listened about or anything. So
I can remember when
I know all the rest of the list. Yeah,
DNA used to be Genentech a long time ago.
Wasn't it in a SPAC, SRNG?
I don't know.
Yeah.
So anyhow, there's some interesting names here. And again, I would do the same thing. I would watch for people who really seem to know what they're doing and maybe watch their transactions for ideas for potentially actionable. There's nothing really fancy about the site. It's just some fun. It's pretty effective.
Well, and then you've got Pat Dorsey from Dorsey Management further on down, and he was with Morningstar. And I noticed that in the last quarter, he bought something new that I had never heard of.
How far down the list here, Kim?
Keep going.
Going down?
Yeah.
Oh, here he is. Yeah.
Yeah.
So Smartsheet actually appeared in a few places, and I think you're talking about Wix, right? WIX?
I'm talking about Wix, and I'd really be interested to see if they're He bought PayPal way after I had it. And I don't know anything about that SEM Rush Holdings.
Yeah,
That was a brand new buy.
I can hear Ken scratching in the background here. He's probably
Yeah.
he's probably already off. One other thing about the site that I found quite interesting is there are some really decent articles here. If you're new to investing, or if you know somebody who's new to investing and you're not familiar with Howard Marks, he writes some really good stuff. The Howard Marks letters and letters to the shareholders are really quite good. And if you're just trying to get your head or arms around investing, or you know somebody who is, Howard Marks is a name you should know, and he writes some excellent stuff. Well, here's Greenblatt right here. We're going to talk about Greenblatt now. Okay. Anything else, Kim?
Really good site, Kim. Thank you. Really good site.
Yeah, the website, again, is Dataroma, nothingfancy.com. Be careful not to go Dataroma. It's another investing site. I haven't explored that one at all yet, but it's data, as in the word data, Roma. All right. Via Twitter, this is kind of our interesting moment, fun. I don't know if it's fun. Interesting fun fact. Interesting fact? I don't know. Just a reminder that even a really cool company that has been good to our investors for so long can have speed bumps, or really, really, really bad speed bumps. I find it fascinating that it dropped 50% on a single day, and this guy on Twitter pointed it out. And then I pointed out to him that it actually fell another 50% after that, back in the year 2000. So again, keep in mind that that is possible. That's why you have 16 stocks in your portfolio, plus or minus 4, or perhaps even more than that. We believe in very focused, very concentrated investing, but just be mindful that this can happen to the best of them. And then placing it even deeper into context, there's that year where that event happened. But since then, and in fact, since that peak, since the peak that is shown here on the left, that's where the statistic actually starts. Apple has been a 250 bagger with a 29% annualized total return. And if you go back and look at the early days of manifest investing, it was not the most widely followed company back in this time frame. Somewhere along in here, I'd have to look it up to see the exact date, it started showing up in our portfolios, and eventually cracked the Manifest 40, and eventually took over the leadership spot, which it has never relinquished in the Manifest 40. It's the most, Apple is still the most widely followed stock on our dashboards, even to this day. But I think that's a phenomenal number.
I can't resist doing a teacherly thing. If you go back one slide.
Okay.
I know that there are people in the audience that went immediately to the right-hand side of the graph and said, oh, 23 cents. You mean I could have bought Apple for 23 cents back in 2000 in December? And I just want to remind folks that all of these graphs and everything that you see, when you look back in history, they're all split adjusted. So you probably never were able to pick up Apple for 23 cents. It probably was quite a bit more than that. Because there's been a number of splits in Apple from 2000 until today. But don't just read these things and bother not to think about what the graph is really telling you. That's 23 cents split adjusted.
Yep. And in many cases, it's split and dividend adjusted for many
Absolutely.
services.
Absolutely. Yeah.
Yep. We could probably figure it out, but we'll do that at some other time if somebody really needs to know. If it's a burning question, just figured out how many stock splits they've had since then.
Well, I just, again, my teacherly instincts say that's a great research project for you to do, and look directly in the eye of the person asking you to do it, you know?
Absolutely. All right. So that's just phenomenal. And our returns in the Manifest 40, and I know a lot of us out there have held stock in this company for a long time. By the way, I still believe that a day like that is possible for a company like Apple, and certainly not hoping for it, but it is possible. All right. like I said before, I started trying to go through the bibliography of inflation stuff, and I didn't make it very far. And in fact, I think I might have fallen asleep, Ken. I'm sorry, but I will continue to try. And in the meantime, serving up in the role of really cool distractions was this quote from Peter Lynch. And this is kind of the way I think about walking into the inflation discussion we're about to have. How does it affect the companies that I try to understand? And where does it show up? How does it show up? I think that's how I want to approach this inflation thought process. Of course, from a macro perspective, but also from a micro. And what this actually led me to, as I was looking for a diversion, was going back to what we did a little over a year ago, actually almost 18 months ago, where we first began talking about this projected return on value concept and the works of Joel Greenblatt. And I actually read both of those books instead of reading my inflation list. So Ken, I apologize, but they kind of drew me in. And my advice to everybody out there, we did feature, I think, these books both in our library stuff that we talked about a year ago. This one is cool. It's actually an all-time classic, but it doesn't have much meat on the bone. A lot of case studies from back in the 90s and right around the turn of the century. Good stuff, good concepts. But I could have saved the time of not reading this one. This one contains the kind of the cousin to projected return on value. There's a couple chapters that cover it very nicely. And that image that I've inserted on the right is the original stock selection guide printed in the National Association of Investors. That actually is the Better Investing from 1951. And it's an SSG, the visual analysis on Lily Tulip. And again, as we have pointed out a number of times, Cy wrote an entire feature on this. Back in the day, again, information was a little bit tougher to get, a lot tougher to get. Nicholson and Seeger basically graphed the sales or the revenues, that's the green line here, and then section 2A, or the pre-tax profit, is this dotted line that you see here. So what we now recognize as a magenta line on our SSGs was also, basically from section 2A. A few years ago, Susie, I think, ported it over to the side one again. That's good stuff. It's an important thing to look at. And I think we're kind of coming back full circle in many ways on this subject. So let's go ahead and launch into it. And Ken, just tell me what you think.
Well, before you get off of that, Mark, I want to focus on that second sentence from Peter Lynch right there. I spent Thanksgiving with the guy that asked about inflation and that put it on our agenda going forward. And this essentially gives the answer that I gave to him consistently over Thanksgiving, probably 18 different times, because he kept hoping for a better answer. And I think that so much of what we're going to say about inflation going forward comes down to what's the company you're talking about and what are the peculiar characteristics of the company. And if you dive a little bit deeper, it comes down to a single word, and that's management. And how is management handling the stresses that are applied by inflation? That's what's going to determine how the company does. And if somebody's looking for a magic tool right now for us to help them predict how a random company is going to act in random inflation, I think they're going to be sorely disappointed at our answer, which basically says there is no tool and there is no predictor, and it comes down to how well the company is managed and how they make it through the whole process of inflation.
Yeah, and in fact, I'm going to skip ahead to the, basically springboarding off of that, because I put this graph here along with this quote to kind of make that point. Nicholson wrote a series of articles back many, many years ago, a few decades ago, where he talked about, keep in mind that this line, this is the revenue line or the sales line, that is inflation impacted. And if you look at the low rate of inflation that we've had for so many years, that has actually put a dent in these long-term curves. And that, you talk about what happens with inflation, that actually is going to increase the slope of that line. Now, it also increases the slope of the cost line. And that's what Ken is getting at. What will it do to this line look going forward? In other words, the overall revenues, if prices are, rise against an inelastic demand, you can actually lose market share. And, it can be a very complex undertaking. But the real thing is what about the cost of the goods and the stuff that go into making whatever product or service is involved? And if inflation goes up and you can't raise your prices, those the impact on cost and profitability is going to be the thing that really happens. So it is on a company by company basis. What would you add to that, Ken?
Well, nothing except, Mark, I really like the note that you've put on the graph, that these two graphs are whole numbers, if you will. They're not divided by shares, so it's not a per share like the earnings number is, and therefore you can't manage these two numbers very well. If you are as old as I am, and if you were doing SSGs by typing in data from value line sheets a long time ago, the place that you would see mismatches in data from source to source to source was always in the earnings. It hardly ever was in sales data. Sales data basically was here's what we sold, and we can't mess around with that number very much because we have to report it. And then the profit data came directly from the sales data. So I applaud any method that is trying to take away the financial engineering that I think I've probably said 50 times in seminars in the last 15 years about how I think it's becoming more and more prevalent and more flagrant as to companies trying to manage their earnings per share to make them appear to be consistent.
Well, and I want to add on all of this is it's management, but it's also how prudent is management with their capital allocation. And one of those things that is real important is capital allocation, and you can look at ROIC, which is what we're also with our proof. But we have to remember we need to look at how much debt do they have, and are their profit margins shrinking because of inflation because their cost of goods is going up. But also in looking at that, let's be sure to always look at executive compensation and what are the metrics they have to meet to be able to get bonuses, because they'll meet their bonuses, whatever it is. Just as investors, if we know what that is and double checking the proxy to find out what that is, that gives us an added benefit to know how our stocks are going to do.
Yeah, and it's all part of understanding, a little bit more underneath the hood without necessarily needing to understand the ultimate nuts and bolts of any business. So,
well, and I feel very comfortable, Mark, in discussing these kind of things with the kind of audience that comes to bull sessions. I feel we have a subset of the audience that we aim a lot of our some of our education at. And that subset that we attract to this particular program is really pretty with it, with the numbers and with arithmetic, with mathematical skills, with understanding definition. And I have no trouble at all telling them that Prove is probably as good an indicator of what the stock might do 5 years from now as PAR is. And we'll get into my only judgment about this whole issue is that I don't want to leave PAR in the dust, because I think that's where a huge section of our audience is, and I don't know if they're mathematically ready or if their psyche is ready to move into something relatively new from what they've heard for 20 or 30 or more years. And that's why I want to make sure that we provide the same kind of sources that we've always provided, and maybe add yet another tool for those folks that feel ready to take that step. I think it's a very useful tool. I think it takes away a lot of the scheming that boardrooms do to make that earnings line look different from what it really is. It still allows them to play around a little bit with numbers of shares, but that's a little bit more direct than some other things they possibly can do with accounting.
Yeah, and
So,
it doesn't even have to be gymnastics. I mean,
Yeah.
the accounting that goes along with it and the tax laws that can be variable, that's all below that line, and that we'll make that point here in a minute. But the thing, one of the things that really inspired me to do this, and I'm going to get a little bit weepy here, I actually went back and Nick D and Kim probably remember this. We actually had a mini workshop online with video, and Nick Strategos talked about, and he did it at the same time that you did, Ken, the possibility that these two numbers could be related or resemble each other. But more importantly, if you're doing an analysis and these two numbers are dramatically different, it probably suggests, well, first, there could be something wrong with the PE ratio selected for the future. And then secondarily, maybe the projected profit margins could be off by a bit. Anyhow, it basically nudges you into auditing and carefully considering, what's different here. Why are these? I think it's possibly a self-correcting and fairly powerful audit on the companies that we do, and that's the point that Nick made in that video, and I think it's worth going back to. So really, anytime you do a stock selection guide influenced analysis of a company, you end up with this number. And this number is nothing more than the number that's out here at the edge of the visual analysis on the far right. And that's the number. The difference between us and what many other people do is this projected out in front here. We really don't do return on capital so much as projected return on capital. That's what sets us a bit different. Greenblatt covers it in the book. We'll probably talk more about that. I want to go and capture some of the highlights from the book. But I do think it comes back to this fairly powerful notion of capturing the absolute strength. Keep in mind, I served on that blue ribbon committee of professional analysts and academics that took a look at the stock selection guide. And I sat and listened to them as they basically oohed and ahed over the way that we treat the visual analysis and section 2. And they became, and I'm going to sugarcoat it, a little bit concerned about the PE stuff. Sections 3, 4, and 5, just because it was a bit outdated. I go through this every year at Thanksgiving. Cutting the ends off the ham reminds me of it. The weakness and the vulnerabilities of the stock selection guide are in those sections. But sections 1 and 2 are cool. And projected return on value uses the output and the considerations that go into sections 1 and 2. And that's what I find really cool. One of the reasons that I think we're kind of circling back here a little bit to a real strength of understanding the companies you're invested in. And here, this kind of makes the point, Ken. I'm not saying abolish or completely get rid of the PE ratio, but what would be wrong with using this type of analysis to nudge a better consideration of PE ratios for companies that we study?
Well, that's right where I sit. So I can buy that 99.9% mark. That's exactly what I feel the value of these new numbers are. I want to go back one slide, Mark. Where is the share number coming from? Where does that default number come from, that 377 that you happen to be using there?
Yeah, that's current shares outstanding.
Okay, would we ever consider projecting shares also based on the way they've been growing or the way they've been declining?
Well, the interesting thing is, if you basically stick to that picture, that visual analysis, you take out the per shares here, right? And some of these are future estimates and projections, and the per share, it's algebra. I'm not going to go too deep into it, but the stock price is per share. The only thing that's left is in per share is the stock price. And you're basically just changing that to the market cap by multiplying it by the shares, taking the shares out of it. And you're literally taking a look at operating income divided by enterprise value. And again, the shares are out of it, except for the current shares to establish current market cap. So I'll let you chew on that one, Ken, but it's
No, I don't have to chew on it. That's where I wanted you to go. So
okay, whoa, we agree.
I think that somebody that looks at the last paragraph and sees projected on 4 of the 5 values, the first thing you do is you wonder, well, is it just mislabeled? Should it be projected shares outstanding? But no, in fact, it shouldn't, because the shares themselves don't figure directly into any of this calculation.
Nope, it's kind of bizarre. It's kind of liberating.
Secondarily.
All right, so
okay, I can buy it.
So don't panic when you see versions of this slide showing up on Manifest as we crunch through a few of these companies. One of the other things that Ken's, I'm not going to say pontificated, but came pretty close. What about the reliability of this as a predictor or as a potential tool in portfolio design and management? And that, I don't have an answer for that yet, but we will, because I do think that because it is less vulnerable to the accounting and the tax accounting and all that other stuff, strategic math, whatever you want to call it, financial engineering, I think we're going to find that it actually strengthens our analysis of companies going forward. So we'll see what that looks like. In other words, the answer to the question, is it more accurate than PAR has been?
And I see no reason why, again, back to slide 9, I see no reason why to not antagonize huge parts of your audience that a PE value can't be included on this list. I mean, actually, in order to calculate PAR, you had to come up with a PE value.
Yeah, I had to put it on there.
Right. So I don't think there's anything wrong with putting it on the list, even though it doesn't impact the proof number at all.
No, because we are using one to validate or audit another.
Right. And having it sit there brings your mind to the fact that if there is the discrepancy, then there's that number looking right at you that you probably need to examine and ask yourself what's going on with it.
So I am going to put together a version of this sheet. I mean, things are a little bit fluid right now, but a version of this sheet, which really, if you want to think about it, as you're sitting out there in the audience, what I'm going to do is walk you through, how we would do an SSG influenced study where, what do you need? You need some version of current revenue or sales conditions, and then you need the slope of that line. But you basically need, some form of sales growth. You need some form of profitability measure. And we'll basically walk through it section by section on here, step by step, so that you can see the calculations and see what impact that they have. So it'll be fun, trust me. And here's one of the other reasons that
it depends on how you define fun, Mark. Just keep that in mind. Okay.
Well, you know me. You know me.
I know. If it involves numbers and calculation, it's fun. Okay.
Or yelling at referees.
All right.
And I'm usually right when I yell at referees.
Oh, Lordy. I need my boots on.
Well, I had an entire career where all I committed were alleged fouls. So it happens. In basketball, we're talking about basketball now, not anything else. Anyhow, the interesting thing about this is if we throw our magenta line, the magenta line, which is part of everything that we do, and just call it what it is, it's earnings before taxes, pre-tax income, however you want to label it, you basically are looking at this situation where you are possibly enabling earlier analysis of companies. That break even actually moves to the left. And the point at which the mathematics or algebra blow up, which is right around that 0 point, actually gets cleared up a little bit earlier in the life cycle of the company. So again, in terms of evaluating launchpad opportunities like we constantly see out of our ladies from St. Louis, and launchpad investing can work for a portion of your portfolio. Obviously, you want to load up on a whole bunch of this stuff here, up straight and parallel. We get that. But there's also opportunity in the non-core stuff to the left. Your thoughts, Ken?
Well, other than on the graphic, I probably would prefer seeing the pink line about halfway through that hyper growth area right there become more parallel to the revenue line. But other than that, I think I'm ready to buy into the concept without any question at all. I really do think that the growth in pre-tax profits, I don't think lags the revenue until you get to maybe a much more mature company. I think it tends to mimic the revenue in a lot of cases. So that's the only suggestion I would have, and I'm not sure how exactly I would draw it, but I would like the idea there that that there's a very close relationship between this revenue number and this earnings per share number, and in an ideal company, they do tend to mimic each other as far as growth is concerned.
Well, we'll put it together for a few. I didn't for today, but here's an example of one of those graphs that you guys all know that I'm falling in love with. This stuff is not just theory. Those are actual numbers for Under Armour. So we can actually put this together we'll pick a couple companies and display it using real numbers. Yep. And I think that is going to really begin to drive some of this stuff home. Because this is more than theory. There's the real stuff for Under Armour. And we'll have some fun with this. And again, we'll ultimately land at the question, is it possible that a prove audit or conditioning of PE ratios and PARs will actually lead to more effective results where actual results resemble forecasts more often than they do now?
I'm ready to sit squarely in the yes column on that one.
All right, let's hope it turns out that way. Otherwise, you might not ever hear from me again. All right.
All right. You're going to have to go incognito somewhere. Yeah, I've moved up into the top 10. All right.
We have a new leader. I think Terry took a hit on, and I actually, that's her investment club, Sirius Pittsburgh, which was one of the annual contest winners in the Groundhog. Won the group entry a few years ago.
So tell us a little bit about Ruth, Mark. The name's not familiar to me.
Ruth is a long-term member of the Manifest Investing community. I can't remember exactly where she lives off the top of my head, but she's been pretty prominent in the long-term results for quite some time, and she's just very supportive. So we're gonna, obviously, if she continues up at the top of this board, we're gonna learn more about her. But it's now becoming more of a horse race, along with Len Douglas. I know Len is out there up at the top, and David Gardner is snuck into the top 6. So we're getting set up for a heck of a finisher over the last couple of months. In general, though, we're all getting
I gotta ask this: is Lisa Robertson a family member?
She is not. She is a volunteer or a very active person out in Puget Sound. We've spent time with them several Novembers in the past with the Puget Sound people, and Lisa's been at all of their conferences. But we are not related.
Okay.
But if she's investing real dollars and getting these type of results, maybe we are related. And I just need to figure out how related. Seeing as how Ken's leaving me off of the list. spending my inheritance on stuff he needs for the house. All right, so you guys see the carnage that's happening on the right. It's probably even worse today. So we'll check back in a week from now. Quick reminder that we do archive all of these broadcasts on YouTube under the Manifest Investing page. You can search for any roundtables, any bull sessions, and any of the successful investing sessions that we've had. This is an old slide. The views are not accurate. That's just there to make the point and the reminder that you can access those. If you find that you'd like the stuff on that page, There's a whole bunch of stuff on some of the stuff we've talked about here today. I've gotten a number of questions about small company diversification and growth diversification. There's a bunch of sessions on that also, our small company stuff. Anyhow, subscribe or join on the page and you will be notified anytime we add new, fresh content there. All right. And with that, we'll sign off with an image that greeted Kim a recent morning, right, Kim? Is that a morning picture?
That was about 6:15 in the morning, and you had a celebrity cruise ship coming in, because here in South Florida, the cruise ships are starting to go. They're not fully 100% yet, but I think last weekend on a Saturday night, I think we had 6 or 7 cruise ships going out. So, and I talked to some friends who went on a cruise, and they had said that the cleanliness was outstanding. You would sit down, people would take their masks down, they'd eat, put their mask up, stand up, and then they were cleaning the, the armrest underneath the armrest on the seats and all that kind of stuff. So there's a lot of cruising starting up down here.
That's good. And Ken, I'm thinking that if there were to be a successful Investing 5, that might not be a bad cover slide.
All right.
Maybe we go with an all aboard theme and just go fly, straight into the teeth of this pandemic challenge that we face.
Well, I'm still not emotionally ready to even think about a 5. So talk to me after the holidays. All right.
Okay. Duly noted. That's why we only do them every maximum of every 6 months.
Yeah.
And I promise not to schedule another webcast for Tuesdays. All right. So with that, I think we can go ahead and shut down. Again, keep your eyes open. We didn't get to talk about possibly reviving the Fave 5. That's something I want to talk about, Ken, perhaps offline as part of what we do here. And I also want to, and remind me of this also, Ken, Barron's has actually started up their regular small cap feature. And kind of want to watch that and see if any ideas pop out of that, and would like to talk about that during a future session. So prod me on that one also, please.
Okay. So we do have some things in the question box to go over, Mark, once you close the recording down.
Okay, everybody take care. Thanks for coming. Hope to see you tonight at the round table. Take care, everybody.
Good night, everybody.